Volume Profiling, Module 3, The Specialist.
Previously in Module 2, The Proficiency.
Let's take a look at the structure of Module 3. As you will recall from Module 1 and 2, every single module comprises of theoretical, practical, and playbook application. In Module 3 you can expect 9 theoretical principles. There will be 4 Blackboard learning series, which is your learning videos. We will then have profile replays, which we'll utilize throughout all the strategy development. You will then at the end of every single part have the usual concept checker, whereby I can ensure you understand the principles dealt with. And then as usual we'll finish every single part with a playbook entry where you can update your playbook accordingly. In this module there will be 11 different questions to update in your playbook. Good luck. Module 3's index looks as follows. There are 4 parts. Part 9, 10, 11 and 12. Each part will begin with a little bit of theory and end with unique trading strategies based on volume profiling. In Part 9 you can expect to discuss composite market profiling as a theoretical principle with some examples. We'll then talk about volume as a control identifier. We will then go over high volume areas and low volume areas. And then I will show you how to develop your very own unique trading strategies. After that, I'm going to show you some of the strategies that I've developed over the last few years. Now in Part 9, we will focus on anomaly type strategies, including the low volume area and a high volume double distribution strategy. Then in Part 10, we're going to move on to principles of developing your pre-open routine and trading templates before discussing momentum volume profiling strategies. These will include the open drive, the confluence initial balance breakout, the consolidation breakout, and the wide initial balance distribution day. Then in Part 11, we are going to discuss the principle of using the price ladder with volume profiles to make trading decisions, as well as the trading secret. We will then move on to trend strategies based on the volume profile. These will include trend days, day 2 trend, and engulfing profiles and value areas. Then in the final part, Part 12, we will discuss the principle of the art of probability, as well as developing your own playbook. We will then finish Part 12 with the last of our strategy sets, which will be reversal strategies, and these will be the gap day and the gap fill, tail reversals, before we finally finish off with a final word. Good luck and enjoy Module 3. So what will you be able to achieve once you finish Module 3? Firstly, you should understand and be able to use composite volume profiles. You should be able to interpret the significance of volume in the volume profile. You should then be able to differentiate and use high volume and low volume to formulate various strategies. You should be able to develop your own pre-open trading routine and trading templates. Then you should have a basic understanding of how the price ladder works and how you can use price ladders with volume profiling. You should then also be able to understand what I mean by the trading secret. You should also understand the art of trading with probabilities. Then you should be able to develop your own personal playbook. You should be able to use, interpret and profit from 11 unique playbook strategies, including the anomaly, momentum, trend and reversal strategies, which I'm going to show you and I'm going to spend a lot of time developing with you so that you have a unique set of trading strategies that you can take forward. You should then be able to develop your own unique strategies with advanced understanding of profiling techniques. So it's all good and well. I'm going to teach you some amazing strategies, but most important, I want you to be able to go and develop your own strategies and continue to improve and update your playbook going forward. Lastly, I want you to be able to have a comprehensive understanding of the volume profiling tool. After all, you are now finally a specialist. This is the suggested timeline that I recommend you take when going through parts 9, 10, 11 and 12. The entire module should take you roughly 13.5 hours. Now, in part 9, I've allocated 1 hour to principles, a half an hour to the summary checker and the Blackboard series, and 2.5 hours to the playbook. In part 10, I've allocated 30 minutes to principles, 30 minutes to concept checker, Blackboard series, and 2.5 hours to your playbook. Then in part 11, again 30 minutes to principles, 30 minutes to your summary and concept checker, and 2.5 hours to the playbook. And lastly, part 12, again 30 minutes to principles, 30 minutes to the concept checker, and 2.5 hours to your playbook. As you will notice, we're going to spend an extensive amount of time developing our playbooks. As you go through the module, you'll understand why. The way I've structured this Module 3 is that I'm going to spend a little less time now on principles as we've developed those in Module 1 and 2. Rather, I'm now going to spend a lot of time helping you not just understand the 11 strategies that I've developed over my career, but more importantly, spend a lot of time getting you finding those strategies within the markets so that not only do you understand those, not only do you begin to believe and trust in those strategies, but you begin to implement them into your very own trading. And lastly, I want to do it so that you can finally not just take my strategies, but begin to develop your own strategies. Part 9. Anomaly Volume Profiling Strategies. Bill Lupschutz once said, "I don't think you can consistently be a winning trader if you're banking on being right more than 50% of the time. You have to figure out how to make money being right only 20 to 30% of the time." Welcome to the theoretical principle-based part of part 9. We're going to talk about composite volume profiling. So what is a composite profile? A traditional profile is made up of 1 day of data. However, sometimes we wish to have a flexible profile that can illustrate an auction that includes multiple profiles or even a time slice within a day. Any profile that is made up of several parts or multiple profiles can be deemed a composite profile. What is important is not the definition, but rather the implications. So very simply, traditionally, a volume profile is 1 day. It includes all the data and all the prices traded over 1 day. But you can take any, say, half an hour section of the day. You can take a couple of days, you can take a couple of months and create a volume profiling. The principle of volume profiling is to try and illustrate where trade has been facilitated over a given period. So any period that isn't a day is a composite profile. So why do we use these composite profiles? Well, very simply, firstly, it ensures we constantly understand the bigger picture. So it gives us a top-down approach. What do we mean by that? Well, if we look at, say, a monthly volume profile, we will see effectively how volume has been distributed over price and time over an entire month. So it gives us a good bigger term perspective of what has actually gone on over the period of a month. Then markets have long-term memory. So again, sometimes we use these composite profiles to develop very unique strategies based on weekly and monthly charts. Why? Because, well, you might, as a day trader, you might remember a certain level and forget about it after a few days. But if you go back and you look on, say, a weekly or monthly volume profile, you will notice that that area may stick out and the market tends to remember these areas. Hence why we pay attention to it. Then, as mentioned before, markets tend to respect previously accepted long-term high volume areas. In other words, a series of prices that has been accepted as fair value by the market, that should tend to be revisited at some point in the future and maybe even become fair price again. Also, composite profiles that can illustrate to us where high probability trade location may be. So if, for instance, over a period of a couple of days and weeks, we've seen that the market is been accepting a lot of value and then suddenly shoots away from value, we can pick up where good trade location would be just using composite profiles. Also, composite profiles illustrate the long-term auction process quite nicely. Now, again, remember, a composite profile is nothing more than a tool. It's a way to illustrate how volume and price is being traded. Now, if we effectively illustrate a longer-term auction process, you will very quickly realize how often the markets are actually distributing in a normal type distribution. And obviously, the counter is how seldom they're actually trending. And lastly, composite profiles illustrate which phase in the trend we are at. Now, again, sometimes we tend to forget that we're in trending markets, and if you were to look at, say, a longer term profile, whether it's a couple of days or weeks or months, you'll very quickly realize whether or not we're trending and which phase of the trend we are in. So those are just some of the reasons why we look at composite profiles as day traders. Let's now take an example. Let's look at a few different examples of how you can, how a composite profile would be illustrated in the marketplace. Now in the following slides, I'm going to show you a few examples of where I would use composite volume profiles. The first example you can see in front of you is what I like to call a fundamental composite profile. What is this? Well, in basic sense, it's when we have a new fundamental in the market, whether it's a change in supply and demand in the oil market, or whether it's a shift in interest rate policy. What I like to do is, when I see these, trending type fundamental news enter the market, I like to draw a composite profile. Now, as you can see on the left of this chart, on the right of this chart, we've obviously got all the candlesticks, but on the left, we've drawn a composite profile. Now all that composite profile shows us is how volume is dispersed over this entire move from the lows up to the highs. Now as you can see, when the new fundamental news hits the market, we can see very little volume being traded in the lower end of this distribution of volume, or in this volume profile. Whereas once the market finally runs into some responsive type selling, we tend to see value being accepted or the market developing fair price. Now, it's very important, and you can see why it's so powerful to use these composite profiles, because we can very quickly pick up where the market has rejected or where the market feels was a discount price, and then where the market feels is fair value price. Now, where I would tend to use this quite a lot, or how I would develop trade strategy based on this, is so long as that fundamental news holds in the market, I'd be looking to keep buying the lower end prices ahead of that low volume area, or that area of prices that very little volume was traded over. Let's take a look now at another example. So our second example is roughly a few hours. Again, this is in a trending like move, but what has happened on this day is we've had a little bit of an open drive, or we've had the market open at the start of the day, and very quickly we've seen some initiative being taken early on. Now when we have these day types, I tend to have sort of two ideas as to what can occur over a course of the day. Firstly, that initiative should, in theory, remain intact. So the reason I draw this volume profile is to ensure that I constantly remind myself as to that initiative that's taken place over the early part of the day. Remember what we spoke about in Module 1 and 2 when we spoke about initiative versus responsive. And we said that when there's initiative, there tends to be a natural bias towards one side of the market. In this example, that natural bias is towards the downside. Now again, as you'll see with the composite profile, is that it helps me to, one, determine where the good trade location is, which is ahead of the low, the area of low trade, where that first orange line is. And then more importantly, it helps me to remain in the trade until such a time that we sort of find discount prices. And we can see once we've found those discount prices, the market very quickly auctions back up towards the top or the top orange line. So again, we can see how volume profiling over a composite time frame can sort of aid us in not just decision making, not just staying in the right trade for longer, not just for determining good trade location, but just generally keeping us on the right side with the right idea in mind. Let's look at another example. So the next example we're going to look at now is a couple of days, and the reason I've illustrated this example is twofold. One, we've got one-time framing. So if you look at the candlesticks, you can see that we have 1, 2, 3, 4, 5, 6, 7, 8, and 9 one-time frame candles where we do not make a higher high, but every single day we're making a lower low. So what we're seeing here is almost a one-time framing initiative being taken from sellers. Now again, what happens is, remember what we spoke about in module 2 when we spoke about one-time framing. This will occur until the initiative move from sellers runs into responsive buyers. As you can see, once we run into those responsive buyers, we get quite a nice bounce until the market finds those responsive sellers that then enter fresh shorts. Now, interesting with this composite profile, as you can see on the right of the chart, you can see how the market almost forms a double distribution where we have one set of prices being accepted, the market then moves lower again and then begins to accept a lower set of prices. So again, using this composite profile now will help me develop a potential understanding and idea of what this market may do going forward, which is potentially fill out the double distribution if it cannot hold the low volume area. I hope you guys are starting to see now how some of the strategies and principles we spoke about in module 1 and 2 are starting to filter through even into composite profiling. Let's take a look at another example. The next composite profile is an example of a weekly volume profile. Again, you can see how composite profiles can really illustrate to us what the bigger picture is in the market. Whilst traditional candlesticks appear to show us that this market is trending, the volume profiling actually shows us, or the composite profile shows us, that it's not trending per se, but rather grinding higher. Now, the difference between a market that's trending, showing initiative that's aggressive, and a market that's grinding is simply that this market is spending a lot more time accepting various prices. So again, we spoke about how composite profiles can show us various parts of the trend, and we would use this sort of analysis to determine which part of the trend we are in. In this example, I would say we're actually approaching the back end of the trend, as we can see the market starting to see or slow up, and the momentum starting to slow, and the aggression having been taken out of the marketplace. Let's now look at what a monthly composite profile would look like. In this example, we can see the monthly composite profile. Note the difference between this monthly composite profile and the previous weekly one. We can see how little overlap there is in the price candles, and this is clearly illustrated in the volume profile as well, suggesting we are probably in the early phase of a new trend. We can also see how quickly the market sort of navigates away from prices in the early stages of this composite profile, before then eventually sort of almost having an exuberant move up towards the high and then finally backing off higher prices. So again, what we'd use this for a longer term picture is, as you can see around the top orange line, that 151.93 area, we'd be looking in and around that area for potential support, for potential responsive buying to re-enter the market. Why? Because this was the point where the market accepted fair value on the way up. That now concludes their examples of the various types of composite profiles you can draw. Now, this is not an exhaustive list by any means. You should learn to firstly understand the principle of composite profile, understand what the information can actually add to your trading strategies. Once you do that, then you need to develop potentially some sort of strategies utilizing composite profiles. We're now going to discuss volume as a market identifier of trade facilitation. Now again, remember that concept of price, time, and volume. Price advertises the opportunity. Time regulates each opportunity and measures the degree of confidence, and volume measures the degree of success of each auction. I'm sure by now you know that definition very well, as we have discussed it throughout modules 1, 2 and 3. But the basic premise remains the same. Every single volume profile consists of volume, price and time, and that's why it's paramount we keep repeating this. More important is the degree of success unlocks vital information about future price movements. In other words, volume that measures the degree of success. It's important we assess this degree of success, as that will tell us potentially what could happen in the future. So what do we mean by that? Let's take a basic example. If, for instance, a new comment comes out or a new piece of information hits the market and we see a very big surge in volume as well as price direction, that is telling us something very vital, which is that the market feels this new information is particularly important. Had we seen this type of move on relatively lower volume, that could suggest to us a number of other factors, such as a potential squeeze or liquidation, or maybe just a very uncertain market as to what was occurring. Then perhaps the most important skill you must master to become a successful trader is the ability to be able to distinguish price from value. Remember guys, it's all well and good looking at a chart, looking at where price is trading, but you need to be able to understand where price is trading relative to something, where volume is relative to previous volume, where the market has come from relative to where it has been. So understanding these elements in its own is not that powerful, but understanding the relative changes is extremely powerful. So let's look at some of the key volume metrics you will be exposed to in volume profiles and which you can develop various strategies on. Firstly, the volume point of control. Remember, this is the point or the price at which the most volume has been traded over a period of day. Again, do we have a very protruding high volume VPOC relative to other days or relative to other prices, or are there a number of prices that could have been the volume point of control? Where is the volume point of control situated? In value, out of value, high of the day, low of the day? Then volume profile at price as a percentage of the day day's volume. So again, how much volume is at each price relative to the total day's volume? If we see that 90% or 80% of the day's volume is transacted in the low bound of the day, okay, that's telling us something very, very important about the way market perceives fair value, or at least which prices the market is perceiving fair value at. Then, the volume value area. In other words, what's the size of the volume value area? Where is it located? How is it located? At which prices is it located? Again, most important is not just the value area or the volume value area on its own, but where is the volume value area situated relative to other value areas, relative to other days' distributions, relative to where we're trading on the week and the month. So it's important to put everything in relative terms when assessing the information. Then, low volume extremes versus bad highs and lows. So again, we've spoken about these bad highs, bad lows. So remember, we shouldn't be transacting high volume at lows and highs, but rather we should be seeing quite a quick auction from these bad highs and lows. And then the total daily volume. In other words, how is the volume being dispersed from day to day? Is it relatively high? Is it relatively low? What is the price response once we have a relatively high volume day? What is the price response once we have a relatively low volume day? So again, remember, it's all about understanding the relative implications of the change in volume. Let's take a look at some of the principles now of volume. So firstly, volume is the most reliable indicator of the market's ability to facilitate trade. Remember, an auction process is all about how buyers are interacting with one another. Now, the amount of transaction taking place tells us a lot about how buyers and sellers are interpreting where price is trading, and that is why we pay key attention to the volume. Then, a market that is not facilitating trade will not survive long. So, if for instance we see, we look at a lot of the property markets around the world, if all of a sudden at these very, very high prices that property is transacting at, suddenly buyers are no longer interested and momentum starts to slow and we stop seeing prices move higher, eventually some sellers are going to step in and take profits. They're going to sell out of those housing. Now, if as prices go lower, we cannot see buyers stepping in, to facilitate trade, the market will keep moving lower until it finds that point where buyers feel property prices are at a discount. So again, the basic example of property is no different to the basic ideas we see in the markets day to day. They are all markets. They all have the same auction process and the same interaction between buyers and sellers and the way they respond. Then, all markets seek to trade at price levels that maximize volume. In other words, the market always wants to be trading at fair value. Why? Because this is the point at which trade facilitation is maximized. Or more importantly, this is the point at which buyers and sellers are finally meeting each other and can execute their various orders without having too much of a concern of price moving quickly away from them. So again, when a market manages to find fair value, yes, it's frustrating for us as traders, but the market is then technically actually doing its function or its job of facilitating trade well. Now, as a basic premise, high volume would intend to imply that trade is being facilitated well, whereas low volume trade is not necessarily being facilitated well and will not continue for long. So again, that sentence on its own doesn't make much sense, but what do I mean by that? So let's say we see a high amount of volume and the market is trending. This is not a move we want to fade. This is not a move we want to employ any kind of reversal type strategies. Rather, we want to be looking for momentum type strategies. Whereas the converse, if a market is moving on relatively high volume, but the market's moving, between a series of prices and accepting value, this is something where we want to be looking to employ reversal type strategies or any kind of anomalies type strategies where we're playing for distribution or continued distribution. And the same can be said for low volume, where trade is not being facilitated and won't continue for long. So, if there is low volume and prices are moving quite aggressively in one direction, leaving all sorts of anomalies like low volume areas, a couple of ledges, and a couple of other anomalies, well, there's a high probability that these anomalies are going to be filled at some point. So again, we employ the various strategies accordingly. And we will talk a lot more about these strategies throughout the module. So let's get on with it. Then, low or decreasing volume in static price increases the probability for a market to move out of range to facilitate trade elsewhere. Again, a rule of thumb. And lastly, the dispersion of volume of a profile will show areas of control. So again, it's all about this idea of when you look at the profile, when you look at the markets, when you look at anything, always try and interpret how are buyers and sellers interacting? Who is winning this battle? Who's creating the fight? Where's the initiative coming from? And where's the response coming from? If you learn to start interpreting the markets in this manner, you're going to unlock some vital pieces of information that the market is actually showing you. Let's now move on. We've spoken quite extensively about volume. We're now going to talk a little bit more about the volume value area. Remember, this is the point where 70% of all the volume transacted on the day is situated around the mean. Okay, so what is that? Let's just look a little bit more closely at what the volume value area can show us, and then I'm going to show you a few examples and how you can utilize the value area to develop various, not just ideas and understanding, but also some strategies. So firstly, the volume value area shows where the majority of trade has been facilitated. Okay, so it shows us where majority of the trade was transacted over a series of prices. Now, the open and close of the market relative to the value area is important to note. So for instance, if the market accepts value at the lower bound of prices over a period of a day, but closes on the high, that's telling us a lot about what occurred or the fight that went on during the day and who won the battle. Then, the value area width provides clues to how trade is being facilitated. So again, it's important to have this as a metric. Remember, it's all about the relative metric. So for instance, let's say currently over a period of 10 days, the value area's range is roughly 10 ticks. All of a sudden on day 11, we see a value area that does 25 ticks, so more than 2.5 times the current average. This tells us something about the market. This tells us something quite exciting about the market. It tells us the potential for, a pickup in volatility. And remember, when there's a pickup in volatility, this equals opportunity. That's why we keep, this metric with us, and that's why we can develop some unique strategies, just understanding the current range or the current average range of the value area. Then, the current value area trade location relative to its previous value area or the previous day's value area shows a lot about the control of buyers and sellers. We're going to talk a little bit more about this location of the value area as we go through the coming slides. So, the question to ask ultimately with today's value area versus yesterday's value area is that how much volume or how much value area overlap is there? So the basic premise is that the more value area overlap, the more buyers and sellers are agreeing to the same fair value as the previous day. If we have no overlap, it's telling us that buyers and sellers, whilst they transacted at one series of prices yesterday, they're now transacting and accepting fair value at a new series of prices. This amount of overlap tells us a lot of information. It tells us a lot about the interaction between buyers and sellers and can give us vital clues about where price and value is likely to be accepted going forward. So, some of the things you can look at is what percentage of volume overlap with the previous value area. So, if you see there's roughly 50% of today's value area is within, today's value area is contained within 50% of the previous day's value area versus maybe say 25 or 10%, that's telling us the degree or the relative change or degree of overlap. And then it's important to understand what percentage of trade is being facilitated above the previous day's value area or what percentage of trade is being facilitated below the previous day's value area. Whilst these aren't necessarily that important, they can provide us with some very, very technical clues. What I'm trying to get across to you is that just using the basic idea of a value area, you can already see you can develop so many unique strategies just leaning on one element or one principle being the value area within the entire volume profiling tool. Let's now move on to more discussion about the value area. So we're going to discuss now the value area placement today relative to the previous day. Now, there's 4 basic ways in which a value area can be placed relative to the previous day. I'm going to show them to you in a sense from a high level of conviction, from a low level of conviction to a high level of conviction. By conviction, I mean sort of initiative or bias being shown or strong early clues being shown from the market. So the first is when today's value area is contained or opens or trades within the previous day's value area. This is the least amount of conviction. Why? Because sellers and buyers are agreeing to the same sets of prices that they agreed to on the previous day. The second example is where we have a little bit of overlap or a percentage of overlap between today's value area and the previous day's value area. Remember, this is still imbalanced market, so it's not the highest level of conviction, but it's slightly more convicted than a complete value area within the previous day's value area. The next level is where the market or the value area is trading completely above or below the previous day's value area. Note this is when a market is slightly out of balance. Also note when a market is out of balance, this brings more opportunity or a different kind of opportunity than say a market that is completely in balance. And lastly, our most convicted is when a market is completely out of balance and out of sort of synchronization, where we have a completely engulfing value area, so an outside day or an engulfing type day where the current day's value area completely engulfs the previous day's value area. This shows us quite a bit of conviction and initiation from either the buyers and the sellers. Let's now take a look at the examples, and I'm going to show them to you on the chart and how they look so you get a better understanding of how they look and what they can mean for your trading strategies. The first example is very clear. As you can see, remember, the value area is all the orange volume. So what we can see on day 2 in this example is that day 2 is well contained within day 1's value area. Now remember, we said this is the lowest level of conviction. So straight away, you should be saying to yourself, when this day type occurs, we do not want to be employing momentum strategies. We do not want to be employing trending type strategies. Instead, we want to be employing reversal type strategies, low volume reversals, anomaly type plays, distribution type plays, where any kind of momentum is short-lived and should reverse. Now the second example, with slightly more conviction than the fully contained value area, is where we have a slight overlap of today's value area relative to the previous day's value area. Now as you can see in the example provided, I've actually given you 4 separate profiling days, and you can see each one has got an element of overlap. Now the reason I want to show you this is because this sort of overlap can continue to occur for a number of days. This overlap, whilst we can still develop various strategies, it's showing us slightly less conviction or slightly less likelihood of aggressive trend in one direction or the other. As you can see and remember, it's important to note what percentage of overlap are we seeing. In these examples, what we can see is that we can see almost roughly 50% of overlap is occurring in each one of these 4 days. Now some days this may occur, or this overlap may only be 10 to 20%. Some days it may be 80 or 90%. Keeping track of this basic relative percentage can help you, it can aid your trading and give you vital information about what the market is trying to do. Let's look at the third example. In this example, we can clearly see a little bit more of a lack of any kind of overlap of the current day's value area relative to the previous day's value area. So all this is telling us is that whilst price was being facilitated in one area the previous day, it's being facilitated in a completely different area today. While this doesn't necessarily indicate that we are likely to trend, it is indicating to us a market that's a little bit out of balance and there's a little bit more of an initiative being taken by either the buyers or the sellers. Again, it's important to look at, one, where does the market close on these day types, but also more important is, we tend to see this sort of type of play within a market that is one time framing. So very typically when we get no overlap, but still inside the previous day's range, we tend to see the market one time framing. So again, this is giving us a little bit of a clue that, whilst the market has zero overlap, we could continue to see prices move either up or down with the short-term trend. Then our last and most convicted of the 4 value areas is where we get a complete engulfing value area. Now in this example, you can see illustrated with the orange, the volume on the current day, or where 70% of the volume is dispersed, completely engulfs where 70% of the volume was dispersed on the previous day. Now again, this is not indicative necessarily of a very strong trend, but it is indicative of a pickup in volatility. And it's this volatility that we want to pay attention to, because remember, volatility equals opportunity. When markets are moving sideways, accepting price for a very long period of time, okay, yes, we can make money, but the probability to make big winning is far less likely than when the markets are more volatile and they tend to move in one direction or the other. This concludes now our understanding and our discussion on the value area as a volume profiling tool. As promised back in Module 2, I said we would discuss high volume areas and low volume areas in a far more in-depth discussion. Now, what we're going to talk about firstly is high volume areas. So, the basic principles of high volume areas is that they are balanced regions, so they are where the market is currently accepting fair value. Note, the activity of trade that's taking place in these high volume areas is basically trade facilitation between buyers and sellers. So remember, it's all good and well seeing a high volume area on a chart, but what does it actually mean? Well, in essence, it means buyers and sellers are accepting a series of prices until new information comes into the market. So fair value is being established by buyers and sellers, and more importantly, we have both buyers and sellers present. Now again, remember, these principles you have to apply to the time frame in which you are looking at the market. If you are looking at a market on a week-to-week or a monthly basis, and you are seeing a little bit of two-way trade or fair value being accepted, this may be in a trend where we're having a current pause. It could be where the market's been moving sideways for a couple of months. So make sure you apply these principles and this understanding to whichever time frame you're trying to interpret it in. Now, some of the observations when it comes to high volume areas. Firstly, a high volume area attracts price in the short term. Okay, so in other words, once a market has accepted an area as a fair value, it does tend to attract prices over the constantly over a period of time. So at some point at a future date, we should come and retest that high volume or accepted fair value. Now, markets have a strong tendency to retest high volume areas. Now again, this is not a hard, fast rule. This is not an exact rule. What I'm trying to get across here is that when you look at a high volume area, when you see it on your volume profiles, what does it mean to you? More importantly, if you go back and you look every time the market develops a high value area, what is the probability that it's going to retest it? This is the objective. I'm going to teach you the principles and the understanding. You need to go and develop the potential strategy. Now, markets have a relatively short-term memory for high volume areas. In other words, what they can tend to do is they might not respect the high volume area when they come back and test it. In fact, they may actually go straight through it. Now, high volume attracts price, but it is not a rigid floor or ceiling. Okay, so what we mean by that is if a market moves away from fair value and then comes back to retest it, as it often does, it doesn't imply this high volume area is support or resistance, or that it will hold as a potential respective level. It is merely a reference point. It is a reference where buyers and sellers previously accepted prices as fair value. Now, a high volume area is not a precise concept. Don't try to be perfect. Rather, place belief in the principle. In other words, you cannot develop an exact strategy. A high volume area is merely telling you about the interaction between buyers and selling. It's telling you about the potential future interaction of buyers and sellers. Okay, and that is the core concept, is to understand what does a high volume area mean principally, and what can it aid in terms of your various trade strategies that I'm going to develop with you and you're going to develop yourself. And lastly, high volume areas will slow the market at least and give you enough time to participate and exit if wrong. So what do I mean by that? It's very simple. When a market does tend to come back to a previous high value area, it does tend to slow trade up a little bit. We do tend to find that because traders or because strategies that are developed tend to trade back towards these high value areas, once previous value is being accepted again, we tend to see a little bit of profit taking and two-way trade. So it's very often that a previous value area does slow trade up a bit. So if you do happen to be in a wrong trade or a bad trade, this is the kind of area that could just give you a little bit of time to get out of a sticky or a bad position. Let's now look at an example of how we can utilize the high volume area. So in the example provided, you can see two very distinct high volume areas. Now remember, a high volume area is not a value area. It's a series of prices that is attracting the most trade over time or over volume. Now in this example, we can see two distinct high volume areas, one at the low and one at the high. Now, the process to trade a high volume area is quite simple. You want to trade toward a high volume area. So when a market is distributing, as it is in this example, there's a high likelihood it's going to trade between high volume areas. So once price shows movement towards the high volume area, we want to then initiate trade to retest the high volume area. So for example, we can see the market is trading up towards the high in this example. Once the market shows that it's, sellers have entered, we're seeing some sell side action, we then want to trade this trade back down towards the lower of the high volume nodes or high volume areas. Now note, Remember what I said to you, this is not an exact concept. Expect a lot of overlap, expect a lot of two-way trade, but the principle remains that trade should facilitate toward the lower of the high volume areas. This is our example of a high volume area. Let's now look at the low volume area. Let's now look at the low volume area. Remember, this is the area where little trade is being facilitated, whether that's through volume or over time. Now, the principles of low volume area, and we dealt with this quite extensively in Module 2, but the principles are that they show us directional conviction. Remember we spoke about control identifiers in Module 2. So the low volume area shows us a little bit of directional conviction. It also shows us unbalanced or imbalanced trending markets. So again, when you see these low volume areas, you're seeing a little bit of initiative, you're seeing a little bit of directional bias in the market. And the question you have to ask yourself is, will this directional bias hold or not? Then some examples will be gaps and single TPOs or time price observations or tails in the market, volume tails or even excess tails. So again, these are all sorts of the types of low volume areas that you can expect to see in the volume profile. Now, some of the observations with regards to low volume areas is that once a low volume area begins to be filled, the sentiment and the conviction is gone. So the initiative is gone. The initial move that we've seen, the momentum and the conviction is starting to disappear, and that means it's time to exit that convictional play. Now note, should trade substantially trade through the value area, we could, the low volume area, we could see a bit of a squeeze. In other words, anyone that was playing with the convictional direction should start to exit those trades. So again, don't be the last one out. When that conviction is gone, when that momentum is gone, and we no longer have that directional conviction, you don't want to be the last one out. You want to be the first one out. And then lastly, low volume areas tend to become high volume areas over time as the market begins to accept the area. So again, if you play for the high volume area, the directional trend momentum play, that's brilliant. But don't forget, once that play disappears, once the low volume area begins to fill out, we should see quite a lot of two-way trade. And the markets have a very strong tendency to turn low volume areas into high volume areas. So again, once we start to fill out low volume areas, you can expect to see a lot of two-way trade, and this is where you want to employ your distribution type strategies. Let's look at an example now of a low volume area and how you would trade this. So the process to trading the low volume area is as follows. Firstly, keep accurate notes of low volume areas. Why? Because they are key reference points. Now again, remember, a low volume area is not just on a day-to-day profile. We spoke a lot about composite profiles, so you can apply any of these principles, both low and high volume areas, onto any kind of profiles from daily to weekly to monthly. Now note, you want to be trading with the predominant prevailing short-term trend. So in the example that you can see here, we have almost a double distribution formed at the end of the day. But what you can clearly see is that the morning period spent at the higher end of prices, we then had an initiative move from sellers, and the market then began to facilitate trade in the lower bound of the day's range. Now note the low volume area, or the single TPOs that are untraded both in terms of time and volume. And the important thing to understand with regards to this is that we want to be maintaining short side trades only so long as the low volume area or single prints remain. Note, once the low volume area begins to fill, you want to look for two-way trade. In other words, once we start to get above and fill in those single prints, not only do we want to stop short side trades, but we then want to potentially look for long trades to fill in the low volume area and turn it into the potential high volume area. Now note, the question you need to ask yourself is, in which direction do you wish to see rejection? So again, this brings into sort of mind the idea of trade location. So again, you got to ask yourself, would it be easier in this example where there's a little bit of conviction in the trend, would you want to be buying this market, or would you prefer to be selling it? And the simple answer is that whilst buy-side opportunities, as you can see, were effective and the market didn't continue lower, that is a much higher probability trade than to short, where responsive sellers re-enter the market ahead of the single prints and the low volume area. Now note, you want to place orders in the market to be looking for short side trades in and around the low volume area. And remember, once the market no longer continues to hold the area where responsive sellers are entering ahead of those single prints, abandon the trade first. Do not be last, otherwise you're going to give back unnecessary profits. That's now our two examples of how we would, or a process we would use to trade both high volume nodes and low volume nodes or areas. Now remember, again, this is not the only way in which you can trade it. The purpose is that I show you the basic understanding, the basic principles of what creates a high volume area and a low volume area. More important, the interaction that creates these areas. Because it's that interaction that you can utilize to develop further strategies using high volume and low volume areas going forward. Let's now look at a summary table where we can see the major differences between the high volume area and the low volume area. We're now going to take a look at a table comparing the high volume area and the low volume area. Firstly though, however, it's important to understand why we utilize high and low volume areas to develop trade strategies. The basic premise is that markets have got memory, and that is why low volume areas and high volume areas work well. But these types of strategies are not easy to automate, and by that definition they can be very profitable strategies for us because there are less algorithms interfering. Now, the important characteristics to understand with regards to high and low volume area are as follows. Firstly, when it comes to low volume areas, your execution needs to be precise. The area of execution is very exact. What we mean by that is, right in front of that low volume area where we've seen the initiative, we expect to see some responsive players entering the market in the direction of the initiative or the short-term trend. That area is very, very small, and that is why you need quite an exact execution. In comparison, a high volume area, we expect to see a lot of two-way trade being facilitated between buyers and sellers, and as such, the area in which you need to execute is far bigger, and you need to be far less aggressive and more passive on entry. Then, note, the low volume area, you want to trade with the short-term trend. Where there's a high volume area, you want to either trade with or against the short-term trend. With regards to stopping out, we stop out very easily with a low volume area once the single prints begin to be traded, or once the initiative shows clear signs that it is disappearing. And in terms of high volume areas, we exit once beyond the parameters of the brackets of the high volume area. So again, note, the risk is far different in the low volume area as opposed to the high volume area. In terms of the low volume area then, markets have memory for low volume areas and can trade low volume areas over days, weeks and months. So they can leave these low volume areas for a very long time, constantly showing this initiative. So, you don't want to, just because you've taken the trade once with a short-term trend, it doesn't mean you can't take it a second and a third and a fourth time. Okay, the market can leave these low volume areas for a very long time. So don't just get out of the trade and not take it a second and a third time. Then in terms of high volume areas, markets have got short memory for high volume areas and can trade high volume areas over days, only a few days. So again, two very differing strategies when it comes to low volume areas and high volume areas. Note, some of the low volume areas will come from gaps and single TPOs and tails, and these are the key indicators of this initiative that remains. Whereas with high volume areas, it's the bracket zones, those clear protruding areas on the volume profile showing where volume is being accepted. Then just note the best conditions, the best preconditions to trade these setups is when, obviously, in the case of a low volume area, the market is trending and we have quite a few low volume areas and there's clear initiative in the market. That's the best time to be executing low volume area strategies, whereas the high volume area strategies, we don't want to be executing these when there's a lot of volatility in the market, rather when the market is balancing and ranging and there's clear highs and lows being established. That is the best time to be executing high volume area strategies. That now concludes our discussion on high and low volume strategies. We're now going to begin to show you how to develop your own strategies, how I would develop strategies. I'm going to give you a great little template for developing strategies, and then finally we're going to start with strategy number 1. Development of a trade strategy. So where do you begin? Well, firstly, you've recognized the pattern using volume profiling. Every single day, you do your debrief, and you're noticing that at a certain point in time, maybe an area on the volume profile, something sticks out that seems to be occurring more often than not. Now, most people go and trade this. They go and put risk on the table, they take the trade idea on, they understand the basic premise of the idea, but they don't fully develop a strategy around the subjective idea. Now, this is completely wrong. And in the long run, this is not going to develop edge for you. In the long run, yes, you might get it right a few times. But in the long run, you're not going to learn to trust the trade strategy. More importantly, when the trade strategy evolves, you're not going to be able to evolve with it. And that is why we develop unique trade strategy. Now, I'm going to show you a process to developing this trade strategy so that you develop trust in the strategy, so that you develop understanding and belief and interpretation. But most importantly, so that you can learn to leverage up on these unique trading strategies. Remember, guys, and we will discuss this in part 12, one of the key trading secrets is leverage. And I will explain to you a little bit later on why. So, what should you do? It's simple. Reverse engineer. Start at the end. You understand the end result. You understand what should and what often occurs. So reverse engineer it. How did it get to that point? Where did it come from? How did it get there? How long did it take? Now, first and foremost, this is the step-by-step process to developing your trade strategy. Again, this is not an exhaustive list. This is merely the list that I utilize every single time I develop a new strategy. So number 1, name the opportunity. Call it whatever you want, but make it related to the trade setup. Now, an example was a trade strategy I used back in my early trading days called the aggressive aggressor. Now, the only way I actually learned this strategy was I kept losing money going against when I thought there was a technical bias in the market. And it always felt so aggressive. It always used to make me feel so unsettled and it used to really frustrate me, and it used to bring up some serious emotions within inside me. And I kind of got this impression that the market would aggressively move one way and then even more aggressively in the opposite direction. So what did I call it? The aggressive aggressor. I learned from something that cost me money, turned it into a strategy, and instead of losing money now in the same strategy, I started making money. And so I called it the aggressive aggressor. It relates to the trade strategy. Now, once you've named it, you then need to characterize the trade opportunity. This is like storyboarding. Create a story in your head. Create an understanding as to what's happening. Maybe the buyers are thinking prices are cheap and they really want to get involved and take whatever prices they can and keep going higher and higher and higher until someone starts selling it to them, and then they want to jump out of the way. Create the story in your head. It's this story that you're going to be telling yourself time and time again when you take on this strategy. So create the story. That's how you learn to remember these strategies. So, what are some of the things you need to look out for when characterizing the trade strategy? Firstly, when and where does it occur? What time does it occur? Is there high volume or is there low volume in this trade strategy? What's the price action like? So how is the market moving? How are buyers and sellers responding in this trade strategy? What are some of the observations you can see within the strategy? What time of day is it? What time of the year is it? What month is it? Is it occurring after data? Is it occurring in the US session, in the European session? This is not an exhaustible list. What you want to do is characterize the strategy in every single possible way. Then, you want to define the rules and preconditions for taking on the strategy. So firstly, what time of day do you execute this? What type of market are you executing this in? And what is your expectation analysis? Now, an expectation analysis is particularly important. So what is it? In simple terms, it's what you would expect to see. So let's take a basic example of a breakout trade. Now, in a breakout trade, we expect to see a pickup in volume, a pickup in the volatility, and a little bit of initiation from either the buyers or sellers. So a little bit more one-sided trade as opposed to two-way trade. These are our expectations. So if we take on a breakout strategy and we do not see these expectations, so maybe we see a lot of two-way trade on a breakout, that is telling us straight away that this strategy is not playing out according to our expectations. Now again, a lot of the time these expectations can actually get us out of good trades, but more often than not they're going to protect us against the trade that's going to fail. And that is why we have an expectation analysis. So those are some of the rules and preconditions you will develop for that trade strategy. Now, the reason we develop these rules and preconditions is because at the end of the day, when we go and analyze the trade strategy, when we go and look at how that trade actually played out, we need to have something we can benchmark the trade against, so that we make sure that if it succeeds, we continuously improve. If it fails, we continuously improve. Ultimately, we're continuously improving the trade setup by being able to benchmark it against a set of parameters or rules. Now, once you have completed that, we then move on to the risk management and money management side of things. Ultimately, what you want to think about here is how much of your day do you want to risk on this strategy? What sort of size do you want to put onto the strategy? How are you going to manage when you go onside or offside? Are you going to pyramid? Are you willing to average? Over what series of prices are you willing to get involved in? These are all sorts of considerations you need to take into account when determining your risk management and money management style. Now again, different setups, different strategies will have completely different risk parameters. If you're doing a momentum trade setup, the risk is far tighter. If you're doing, say, a high volume area setup, remember we spoke about a lot of two-way trade and a more passive entry. Therefore, you might see a completely different risk profile. It's important to make sure you understand the risk profile for each individual strategy. Once you've done that, we then move on to the execution methodology. Now, this is one of the most crucial parts because every single price, every single increment in the market is effectively money gained or lost. So, the questions you need to be asking yourself is, how do you enter? Are you aggressive like in the low volume area? Are you more passive in the high volume area? Okay, are you entering with limit orders or are you entering with stop orders? Then, stop placement. Where in the strategy, in other words, where the stop placement is very simple. I get this question very often where people ask, where do you stop at? Is it for a certain number of prices? It's very simple, and listen to me carefully. You stop out where the trade strategy is invalidated. In other words, it's no longer validated by what you initially got into the trade for. So in simple terms, again, with the breakout trade setup that we spoke about, if you're expecting an aggressive move up and you're not expecting to go very far offside because you are going with momentum, the minute you do go offside, or the minute you do see that two-way trade that's not expected, that is the point at which you exit. Not the point of a predetermined stop, not this business of a trailing stop. You exit where the trade strategy is no longer valid, and that is what a stop is. It's the point that stops you out of a trade that is no longer valid. There is no hard fast rule when it comes to stop placement. The hard fast rule is very simply, you get out when the trade is invalid. Now, once you've done that, you then want to look at where you want to target. In other words, where are you getting out of the trade and taking profit? Again, There's no hard fast rule. There's no risk reward of 2 to 1, 3 to 1, 4 to 1. That's what the textbooks teach you. That's what these gurus teach you about taking 10 to 1 risk reward. Okay, I'm going to tell you something. That's all rubbish. You take your profit where the market tells you to take your profit. Again, what do I mean by that? Let's talk about that breakout example again. The market's going higher and higher and higher. We can see the breakout. We can see the initiative from buyers in the market. The minute we see responsive selling enter the market, that's the point at which we exit. That's the point at which we take our profits. Why? Because we can see sellers, other time frame or other, participants stepping into the market, taking the opposite side trade. That is the point at which we need to get out of our breakout setup. Not this business of targeting this area or getting out of that area. We get out when the market tells us to get out. Now, once you've done the execution methodology, we then move on to expectation analysis and emotional tracking. So crucial, another important section which I'm not sure many of you have thought about before. So, what is this? Well, simply, what do you expect to see? What's the kind of interaction, the speed, and the price response? We spoke a little bit about time in Module 2, and we spoke about how crucial time is at measuring the success of a trade. Remember, if you're trading a momentum type play, the time expected to see success is far slower than, for instance, if you're trading, say, a bracketing high volume area trade. This is crucial into understanding because when you have an expectation analysis, when the market does what you don't expect it to do, that's a very, very early clue that something is actually not quite like you thought it might have been. That is the time you want to exit. That is the time you want to reduce risk. When there's uncertainty or a lower probability of success, that's where you exit. You enter because there's a high probability of an event occurring, and you exit because the probability of success is diminishing. Now, what you then need to think about is, how do you feel with your risk and your stops? Not many traders think about this in terms of their emotional tracking. So what do I mean by this? Certain traders are very good at sitting offside. Certain traders are very good at taking risk. Certain traders don't mind going a long way offside. But then there's certain traders that hate taking risk. And that's okay, guys. I'm not suggesting at any point that you take any one of my 11 strategies and, employ them as though they are the Holy Grail. You need to understand yourself. You need to understand how you assess and how you take risk. So every strategy you develop, understand the emotional aspects surrounding that strategy and the risk you're going to be taking. If you struggle to sit in trades for a long time, that's fine. Yes, that is a weakness, but rather focus on your strengths. Okay, if you struggle sitting in trades, well, don't develop your strategies around sitting in trades. Develop your strategies based on the strengths that you have, based on your emotional strengths. Then, we discussed the time required for success. How long do you expect it to take till you achieve success? And then lastly, the overall process. In other words, you want to be understanding what the process is surrounding your overall strategy. Now, important to understand is that in addition to knowing the market, you have to know yourself. That is what this number 6 is all about. Expectation analysis and emotional tracking. You need to know yourself because it's yourself that is going to be leveraging up. It's yourself that's going to be taking risk. It's yourself that's going to cause self-doubt when maybe a strategy isn't quite working out like you expect it to. That is why we pay attention and do this emotional tracking within our trade strategy development. Lastly, step number 7, constant evaluation and improvement. Every single time you take on a strategy, at the end of the day, you need to go over that strategy. You need to go look point for point how that strategy played out. You need to annotate it. You need to look how the buyers and sellers interacted. You need to find any sort of observation that was either as you expected or not as you expected. Because it's this constant analysis and self-evaluation that is, one, going to improve this trade strategy over the long run, but more importantly, it's going to make you the master of that strategy. That is where real edge is developed, is in mastering a strategy, in understanding every angle, every element of the strategy. Most important, trade strategies come into favor and they go out of favor. Sometimes they're working very well for a long period of time, sometimes they're not working so well. By constantly self-evaluating, we can pick up when all of a sudden these trade strategies aren't working so well, and then we don't employ them as aggressively. We reduce the risk when these trade strategies aren't working so well. That is the 7-step process to developing a trade strategy. Now, a lot of you should be sitting there and saying, well, actually, a lot of these things I've never thought about. You should be thinking about them. You should be developing every single one of your trade strategies in this exact manner. When we go through the rest of Module 3, you're going to see how I assess every single trade strategy based on all these various characteristics and parameters. Now, go and develop your trade strategy in the way that I've just shown you, and hopefully you can start developing some highly effective trade strategies. So before we begin the series of 11 unique trading strategies, let's take a look at a template which you can utilize and which I'm going to utilize in the slides and strategy development ahead. So first and foremost, remember, name the play. What is it called? The unique name. What are the characteristics about this play? What are the rules and preconditions for this play? Money management. Where's your risk? How are you going to enter and exit? Execution. Where's the stop? Where's the entry? Passive, limit order, how are you getting involved in the market and where you're going to take profit? Then your expectation analysis and emotional analysis. And lastly, the constant evaluation and observations around the trade setup. Now, what we're going to do going forward is, I'm going to take this template. I'm going to start by developing 4 unique subset strategies with you. Those subset strategies will include anomaly strategies, they'll include momentum strategies, they'll include trending strategies, and then reversal strategies. In each one of those subsections, you will then have unique trading strategies, which I'm going to show you throughout parts 9, 10, 11, and 12. Within each one of those parts, once I've shown you the strategy on the charts and in terms of the template, I'm then going to show you a replay function. So I'm going to show you how the strategy plays out over the period of a trading day that has already occurred. As we go forward through the rest of Module 3, we're going to be discussing 4 unique categories of trade strategies. Those will include the anomaly strategies in Part 9, then momentum strategies in Part 10. In Part 11, we'll discuss trending strategies, and finally in Part 12, we'll discuss reversal strategies. So the first of those, anomaly strategies. We're going to firstly define this first category of strategies. And I'm going to define it by starting off with regards to the time frame players. Now, remember, anomaly strategies include things like low volume areas, bad highs, bad lows, high volume areas, anything that shows a distribution is not normal. So what you want to interpret is the following things. Firstly, what sort of time frame players would you expect to see in anomaly type strategies? In this instance, you definitely don't want to see longer term time frame or swing time frame. You mostly want to see more short-term time frames and algorithmic time frame players. The reason being is because these sorts of time frame players are not so influential on price. If we do see time frame players, it's highly unlikely the anomaly is actually going to get filled. That is why we'd rather see short-term time frame players like algorithms and short-term traders. In terms of initiative or responsive, ideally, in order to see bad highs and bad lows go, we need to see more responsive type price action. We don't want to see too much initiative being taken. In terms of the time objective, how long do these anomalies take to finish? Well, ideally, we'd prefer it to finish within the day's time frame. Then in terms of volume and volatility, again, with anomaly type strategies, we prefer to see lower volume and slightly less volatility. We don't want to see aggressive type price action, as this could mean that maybe the anomaly is not going to get filled. And then lastly, or second to last, in terms of risk reward, we can define that anomaly strategies have got almost one-to-one type risk reward, and therefore they're not, we need to sometimes sit a little bit longer in these trades in order to get our desired objective. And lastly, there's very low very low momentum when it comes to anomaly strategies. So we don't want to be employing momentum type strategies, but rather almost, sort of fading type strategies where, we're looking to go against any initiative moves in one direction or the other. So let's now finally get to our 2 trade strategies that we're going to develop under the anomaly strategies. The first is the low volume area, and the second is the high volume node double distribution. We have now defined the anomaly strategies in terms of the various time frame plays that you can expect to see, the type of price action, whether initiative or responsive, time objective, volume and volatility, the potential for risk reward, as well as momentum and the lack thereof. Now, it's imperative you take all these definitions and you apply them to each one of the individual strategies that we go through. Now, as we go through the strategy, I'm going to cover some of the following elements: the name, the characteristics, the rules and preconditions for the trade, money management, execution, expectation analysis and emotion analysis, as well as the concept of constant evaluation, before we then move on and begin our series of replay functionality. Now, I will then apply each strategy with recent examples taken from the markets we've discussed throughout this course, being the German Bund, the E-money, the Eurodollar FX, and the WTI oil. So let's move straight into it now with our first strategy being the low volume value area. So the first thing that we want to discuss is begin by giving it a name. Now, I've obviously given it the name the low volume value area, and the reason is because obviously we see this characteristic or this low volume or sets of single prints that stick out. So for me, that name makes sense. Make sure you have your own name that makes sense. Then, the first characteristic that we're going to talk about is the idea of trade location. So firstly, you want to interpret where does this strategy occur? At which point? Is it inside the previous day's range, or is it outside of the previous day's range? Is it from a balance perspective with regards to the previous day, or out of balance? All of these sort of definitions we spoke about throughout Module 1 and 2, you need to apply in terms of the trade location. Then we talk about the single prints and the size of the single prints. Now, the size of the single prints, as you can see in this example, is relatively large. But what happens if it was, say, half that size? Now, the size is important because it tells us the strength of the initiative. Then, the location of the initiative. So, where does this, break, or where do these single prints occur in terms of the, trade location? Is it occurring at maybe a key technical support level, or is it occurring maybe at, within the previous day's range? At which point is it occurring? Again, by defining where it is occurring, it'll tell us, how sustainable the initiative and the single prints are. Then, we talk about a level of conviction. Now, by level of conviction, again, this is more about, what is the likelihood that this will hold or the initiative will hold. And some of the things we want to interpret there is, in terms of location, are we inside the previous day's range or not? Are we balancing or not? Are we outside of the previous day, or is there even positioning in the market? Don't forget, a lot of the time these single prints could be created because there's positioning the wrong way around. The next characteristic we will discuss is volume and volatility. So the important thing to understand with regards to this is we need to see a pickup in the volume as well as obviously the volatility. Now, we've spoken in depth about volatility being nothing more than sort of an expansion of the TPO, or a much wider TPO relative to the rest of the day. And we can see that in this basic example, how the market was sort of moving relatively sideways before we then got a bit of range expansion in the P and S prints. Now, again, another important aspect is that what we ideally want to see characteristically is we want to see the TPO or the range being extended by at least 100%. In other words, what we've created here in terms of a range from 51.60 up to 52.10, we want to see at least 50 ticks to the downside. And again, this is more because this ensures that we are actually seeing initiative, instead of just maybe a short-term burst towards the downside. Then it's key to interpret also what are we running away from? Where are these single prints being initiative being taken from? Now, what we mean by that is a market that, for instance, is trading, or been trading for some time in a tight range that then breaks lower, versus a market that maybe has a much smaller distribution before breaking lower. The one with a much more accepted or pronounced, accepted area has a higher probability of maybe selling off, but then also filling in for the rest of the session, versus the second example where we have a smaller, accepted area. And again, this is more to do with, how the market has accepted various prices over the period of the day. So again, characteristically, we want to define, what area are we breaking from? What has occurred in the area we are initiating from? Then it's important to understand the rules and preconditions that we would like to see before taking this play. Now, I'm going to go through them very briefly on the chart, but first and foremost, we want to see single prints or a low volume area. We want to see volatility plus volume, and we want to see, thirdly, at least 100% expansion. So these are three vital conditions, and we can see it in this example. We can see the single prints and with the low volume area, we can see a pickup in the volatility as explained with the sudden shift in the R and S print, and we can also see 100% range extension as explained earlier. So straight away, the preconditions are there, or the rules are there for us to take on this trade. Now, one of the key rules that we have is that when you see this sort of play, you don't want to fade. So you do not want to be sitting at this point looking to try and buy this market somewhere up. Okay, that is not the trade. We will go through the strategy or the actual execution in a minute. Now, what is important in terms of rules is when we do enter on a pullback, we want to be entering quite aggressively. And again, I will show you where this is actually executed. Then in terms of the money management, well, it's very simple. What we're trying to effectively do is we're trying to enter in terms of trade location where we can manage the most effective risk. So in terms of the chart, if we're entering down here for fresh shorts after a relatively, or after an almost 100% extension, we're putting ourselves in a relatively weak position for short. So it's very important that you understand in terms of the management, we're looking to execute in front of the single prints, but after a decent pullback. In terms of the risk, once we've entered and the market has turned back towards the downside, as we can see in this example, we then place our stop above the point where the market pulled back and responsive sellers re-entered. Then lastly, in terms of clip management, it's okay if you do enter a little bit early and go a little bit further off sides. That's not an issue. Remember, the first time you take this trade, you are still, there is still that little bit of initiative in the market. So it's okay to have a wider stop because, in essence, we're looking for a target back down towards the lower end of the distribution. So that would be our target. So note, we can see we have sufficient risk or sufficient reward to give ourselves a relatively decent stop. Now, moving on in terms of the execution and how you take the strategy once the preconditions and rules have been met, it's very simple. We are looking for the first pullback. So the first time after this market showing the initiative, we are looking to enter on the first pullback. Now, it's very important to understand on the first pullback, you have to be aggressive. Okay, so the first time we come back and find those, responsive sellers, you need to be aggressively looking for shorts, targeting the lower end of the distribution. So that is trade strategy number one. The second time the market pulls back, okay, we then want to be more passive on entry. So we don't want to be as aggressive. We still want to be short so long as the initiative holds. We enter a second time passively. Again, our stop goes above. And again, we're looking for just a rotational type play, in the second attempt. So that is how we would execute a low volume area. Remember, in terms of risk, we continue to stay short given all of our characteristics have been met, so long as the low volume area or the initiative area remains. Now, just in terms of some of the expectation analysis and emotions, I won't spend too much time on this, as emotional analysis is very important, but I will give you a little bit of example of something that I would spend time with. Now, in terms of the emotional analysis, for me, by understanding that if I enter too short in this example, maybe somewhere around here, I do have the potential to maybe head offside, or maybe the market goes slightly against me. But by interpreting that I might go offside very early on, this will enable me to sit in the trade even when I do go offside, because I've emotionally understood what the potential is in terms of my risk. So make sure that, when you do talk about emotional analysis, make it personal, make it so that, it makes sense to you, but also that you understand from an emotional aspect what you might experience in the trade strategy. And then in terms of some of the key expectation, well, time is a very important expectation in this, because once we enter on that first pullback, we expect the market to relatively easily auction low. Why? Because firstly, we get the initiative sell-off move. We then get a first pullback, and we should see some responsive sellers step in pretty aggressively and move the market lower. So by definition, if we expect strong responsive selling on the first pullback, by the token of time, it shouldn't take that long. So allocate a number of time. In this instance, I would say a maximum of 3 TPOs in order to complete the distribution move. If it takes more than 3 TPOs, then we exit, okay, because the expectation has not been met. So that then, what you would then do is you would constantly take this trade setup and you would constantly adjust it in terms of the characteristics, the rules, the money management, the execution, as well as some of the expectation analysis. And you would constantly evolve the strategy so that it's constantly improving your overall profitability. Now, let's now move on, to an example of where we would see this playing out in slightly different, conditions. So let's just move to the next slide, and I can show you some of the different variations of the low volume area. So the first we would look at is the German Bund 10-year. And as you can see, again, this is now a day 2 low volume area. So this would be our day 1, and this would be our day 2. But the definition still remains the same. You can see our characteristic. We have our little bit of a accepted area. We have our little bit of single prints, low volume area, relatively small set of single prints. And then the next day, notice how the market respects that low volume area. And we can see the market, first time round, we get that buy side opportunity. And again, notice it takes, 3 TPOs, and then we can get out around this Q print, and then it comes back a second time. It tries to attempt the fill-in but fails, before then rotating higher and forming an inside day. So again, a second example of what the low volume area strategy would work like, just with a slightly, looking slightly different as it's over 2 days. And then our third example would be where we have, again, a low volume area or a low volume area. But as we can see in this example, notice how, the market is almost slowly moving outside of the previous day's value. So it's almost as though the market was firmly imbalanced. The next day we've kind of come in, we've spent a little bit of time in the euro-dollar in the overnight session within the previous day's value area before the market relatively quickly moves out of it and accepts a value area a little bit higher. Now, just important to interpret with these 3 examples is how we've gone from, from a trade location where we have a very convicted low volume area to a less convicted low volume area. Let's just illustrate what we mean by that. So in the first example, we spoke about how, we had an initiative move in the same day where the market left a really large set of single prints, and we could have been relatively aggressive looking for a distribution move. The second example, we spoke about having it the second day. So again, we had a low volume area lower down, and we spent the next day, within the previous day's accepted area, but again, looking for buy-side opportunities. And the third example, as you can see in front of you, was where we again had our sort of, previous day's value, but spent a little bit of overnight session before accepting value outside. Now, all three examples are an example of the low volume strategy, but all three examples sort of the outcome varies from very confident move to a slightly less confident move. Those are then the three types of examples you would expect to see in the low volume strategy. So now that we've dealt with them, let's go and take a live example, a live recent example, using the German Bund, and I can show you with our replay functionality, not just where the characteristics are, but also how we execute, over a live market. Welcome to the replay series for the 11 unique trading strategies we are going to develop throughout Module 3. Some important things to understand before we begin is, why do we utilize the replay function? Well, first and foremost, by having a replay function, we can deliberately practice very specific skill sets. Then secondly, when you have a replay function, you're able to, through speeding up time, you're able to visualize what certain patterns are going to do over a sped up time. So you can enhance your learning curve so much quicker. And thirdly, by having a replay function, this can help you through a series of a number of examples. It can help you to build confidence to stay in the various patterns that you are developing for yourself. Now, two things to just keep in mind. Whilst I'll be showing you various live signals that the profile will show you over a sped up time frame, it's important to understand that it's never going to be as straightforward as I'm going to illustrate you, and that is one of the things you must keep in the back of your mind. Whilst I'm going to show you a lot of textbook type examples, and whilst sometimes the market does give you these really easier opportunities, it's not always going to be that easy. And that's why by having a replay function, you will have, say, 10, 20, 30 examples of each strategy, and you will learn to decipher between all the various different methods or ways in which the same principle can play out. That is why we have these replay function available to us. So let's get into it. Now, what we're going to discuss as we go through each and every one of these replay functions is, first and foremost, we're going to talk about some of the characteristics. We're then going to talk about some of the execution style, and we're going to talk about some of the management style. So these are the three key pillars we're going to build as we go through each and every one of the 11 strategies that we're going to develop. Now, let's get straight into it. So our first strategy that we spoke about was the low volume area. Now, first and foremost, what I want to do before we actually push play is I want to just develop a little bit of context, give you a little bit of understanding. Now, it's imperative that each one of these strategies, whilst they have very specific characteristics, execution methodology, and money management, every single one of them needs to be put into a precise, exact context, because it's this context that is going to determine how the strategy will actually play out. So, remember we spoke about, we had three different types of low volume area strategies. The first and foremost was when we had a low volume area which occurred on the breakout. So the most confident was where we had a breakout of the previous day's range and we had a low volume area developing. The second one we spoke about was where we had a breakout within range. So within the previous day's range, the market left a low volume area. And then the third type was where we had a low volume area at the end of a day. Now, these three are three various types of context that you'll find a low volume area strategy within. The one we're going to discuss in this example is where we have a low volume area within the previous day's range. Now, the example that is in front of you is the German 10-year Bund. Now, what we're going to do is let's play this forward, and I'm just going to point out some of the characteristics, some of the early identifiers that sort of, the observations that show us that something is occurring in this setup. Now, If you watch quite closely, the market opens, and we can see that the market just trades in a relatively tight range initially. Now remember, bear in mind, if we drew the previous day's picture, we would see something a little bit like this, where we had quite a lot of value accepted at the low and our low volume area at the high of the day. Now bear in mind, we said to ourselves, when we have a low volume area, this shows us initiative. Now straight away we can see the market tries to form a double bottom. And notice how once the cash comes in, the cash market takes us all the way back up to the high end of the distribution. So what we're looking for now, given that the previous day we had the low volume area at the high of the day, we're looking for any sort of rejection or speed off the lows to become a buyer. Now as we can see straight away, both on the M and the N print, the market is giving us relatively easy buy side opportunity. So again, if I can illustrate the previous day's context. So as you can see, the market is trying to fill in the low volume area from the previous day. And every time it comes in towards the low of the day, the market gets lifted quite easily and quite aggressively. As we can see now, we have a higher low being formed on the P print. Again, we can see a higher low formed off the Q print. And notice how the auction, we're starting to see a little bit of volume and volatility come into the market as we break above the morning highs. Now note, the R print comes and it tests the initial balance high before then continuing higher and making a new high on the day. So what we can see here is not only are prices being bought up off the lows relatively easily, but any sort of a pullback now, as we've seen a little bit of buy-side auction come into the market, that too is being easily bought up. Again, note the one time framing. So we can see the P print, the Q print, the R print, and now the S print all making a series of higher lows and higher highs. Now again, what we want to observe is when this pattern breaks down, which it does finally on the T print. So had we been looking for longs, whether it was on the M and the N print, whether it was an extension of the initial balance high, whatever it may have been, we've been looking for longs as a result of the low volume area left on the previous day. So because of the initiative left on the previous day, we'd be looking for longs when the market shows us any indication that there is buy side in the market. Now as we can see, the market is still struggling to make ground lower. We can see that the sellers are not committing to lower prices and the buyers keep absorbing and keep reloading on any sort of a pullback. So yeah, we can see both an R, an S, a T, and a U, and now a V print that are constantly holding on to higher ground. So what we're looking for is we're looking for either buy-side opportunity towards the low of the day, or we're looking to remain in longs so long as we can hold on to this little bit of support barrier being formed. Now, once the W print comes in, we can see that the market is now taken out the 50% of the day, but it's also now starting to hold on to lower prices. We no longer want to be buying higher prices now, but rather flattening our position until we get the potential opportunity to buy in and around the lows again. Let's watch now what the market does when it comes and retests in and around the low of the day. Again, note the auction process. Notice how we shifted from having a lot of two-sided trade to one-time framing again. We can see the V print, the W, and the X print all showing us one-time framing. Okay, again notice how quickly the market, once it got to low prices, we saw a very quick reversal of price. So the first thing you have to say to yourself with regards to a characteristic of this trade setup is that lower prices get picked up relatively easily. Now, in noting that, whenever you see this trade setup, what you want to say to yourself is that when the market is offering lower prices ahead of a low volume area, that seems to be the best risk-reward time to get involved, as the market pays out relatively quickly. So we saw it both on the X print, we saw it on the M and N print, and now let's see it on the B print as it plays out live. So as you can see, the B print made a new low on the day, and straight away it got lifted back up and the market very quickly reversed in the opposite direction. So we can see it on the M print, the N print, the X print and the B print. So the market's given us 4 separate opportunities to get involved ahead of the single prints. Then, the question is, the second characteristic is we see a lot of buying, both passive and initiative. And that we saw both the initiative off the lows, but then also the passive at the higher prices. So as you guys can see very clearly in terms of characteristics, we can see how a low volume area allows us in this day type, in this context, to be buyers, both easy buyers at low prices, but then also sort of more passive buyers at higher prices. As you can see, the most important thing to understand is that a low volume area shows a natural bias or tendency towards one side. And that is why we developed this trade strategy, because it gives us relatively easier opportunity and understanding. Now, where we want to just finish off is in terms of execution. So in terms of the execution style, well, what you need to note straight away is, note how if you were aggressive at M, N, X, B, C, and D, notice how we be aggressive at lower prices, and we be passive at higher prices. That's the key to trading this strategy, is to notice where is the trade location that I can afford to be aggressive and where is the trade location that I need to be passive. Then, in terms of management style, what we want to do is we want to be executing at the market in and around lower prices, but then when we get towards higher prices, we want to be taking profit. So we're not looking necessarily for these extensions. Okay, what we're looking for is, if we buy at these prices, can we get a profile distribution? Okay, if we buy it at these X's, can we get the profile? If we buy it at the B's, can we get the profile? So in essence, what we're looking, when we buy off the lows, we're just looking for a distribution play. We're looking to buy low and take profits in and around the high of the distribution. So that's the low volume area strategy that we've developed throughout the beginning parts of Module 3, and that's the execution style and the characteristics you can expect to see when, not just finding this low volume area, but also executing this low volume area. That concludes the first of our strategies throughout this replay series. I hope you've enjoyed it, and I hope to see you guys again in Strategy 2. We're now going to discuss strategy number 2, the double distribution, which is the second of our anomaly strategies. Now, the important thing to understand is to cast your mind back when we spoke about strategy 1, and this was all about the low volume area. In strategy 2 now, we're basically going to talk about the high volume area, and all that occurs is when the low volume area strategy is complete and we start to see the low volume area fill out, we then revert to our high volume area trade strategy. So we're going to be developing 2 sort of unique sort of patterns with the high volume area, but in essence this is nothing more than when the one strategy is complete, we can then move to the second strategy. Now, in the example provided in the chart, you can very clearly see the 2 various domes on day 1. So we could see the market sort of had a nice little value area up higher, and then it had the initiative move, and we formed a lower value area. And then on day 2, the market began to fill out the low volume area. So as we can see in this example, the market initially held on to shorts within the low value area, but then suddenly began to fill it in. On day 3, we then completed and filled out the low volume area. So this would be a typical example of a double distribution, but over a number of days. Now, again, important to note, this strategy can occur in one day, where we fill out the low volume area on the same day, or it can occur the following day, or even over the following days. Now, let's move to this example and start to discuss some of the characteristics, conditions, execution, and money management you would require. Now, the first thing to understand in terms of the characteristics is obviously we need the 2 dome shapes, the 2 separate high value areas. Now, what we're effectively looking for is once the market has failed the low volume area, so step 1 is when the low volume area begins to fill. this is almost our sit up straight and pay attention type clue. Now, what we're looking for is once the market starts to fill out this low volume area, you can expect a lot of two-way trade. Now, it's important to define what this two-way trade looks like, and I'm going to show you what it looks like. One of two things can occur whilst filling out the low volume area. One, the market can come in and slowly but surely grind out and fill out the low volume area. Or two, the market can come into the low volume area and fill out straight to the other side before then rotating lower. Now, in these two examples, you're going to employ two very different types of execution. Now, in the first example, what we're looking to do is we're looking to ideally trade the market from the perspective of strong trade location. So what should happen in theory is the market should fill out this low volume area where we have buyers towards the lower dome and sellers within the middle part of the higher dome. Now, if the market, as in the first example, slowly grinds out the low volume area, this is not as effective, or at least it would still work, but it's a far slower type trade opportunity as the second one. In the example of the second one, if we do a straight line move or relatively aggressive move through the low volume area, this gives us a much stronger short on the first time test of the top dome. Equally, if the market then moves back lower, we want to be looking for a first time buy, and then the market starts to fill out the trade. In the first example, however, we still want to be looking for buys, but it's important that we remain very passive on entry and execute in strong trade location. Now, let's just talk about what we mean in terms of this trade location, as it is a key element when it comes to the execution. Now, what you must understand is if you are going to become very good at this trade, you need to be patient and wait for the point where the market gives you a good entry. Now, the mistake a lot of traders tend to make with this strategy is they tend to enter too aggressively at the wrong time. So, what do we mean by that? If the market is trading right in the middle of this distribution, there's roughly a 50-50 chance as to which way it may go. It may fill up higher, it may fill up lower. So it's important to understand that we look for buy-side opportunities towards the lower end of the low volume area, and we look for sell-side opportunities towards the upper end of the low volume area. Now, again, imperative to understand is the risk-reward metrics of this. Now, in terms of the risk-reward, we are looking for 1-to-1 risk-reward. Now, that's not necessarily comfortable for most people, but the simple reason is that it's very difficult to define risk in this trade strategy. So by that very nature, if you are buying it at this point and you're expecting, say, a 10 to 15 price target, well then, at least by putting a stop of, say, 10 prices, you are managing the trade, which will ultimately make it effective in the long run. So important to understand with regards to risk reward, there is no exact stop that proves the trade strategy wrong, and that is why we try and use the potential reward as our potential stop. Now, what's important to understand again is when the market does have these double distributions, it can take quite a lot of time to fill out. So that is again why it's essential to interpret how does the market fill out the low volume area. Does it move aggressively from point to point, or does it, as in this example, take 2 or 3 days? Again, note, whilst the trade worked effectively in this, it did take quite a substantial amount of time. So do make sure you factor in time when determining how you're going to execute this trade strategy. Let's now look at another example of what the double distribution could look like. Now in this example, well, this is obviously now we can see the rotation, so just in terms of execution, note we're looking for buy-side opportunity and buy-side opportunity in good trade location. Again, notice how if we do buy in that good trade location, the market does give us the opportunity toward the upside. Note this is the point, the blue line, where the low volume area begins to fill out. Again, then note on day 2 how when the market does give us that buy-side passive opportunity, we do get the potential toward the upside. And again, lastly, just to point out, again, we said as we reach that top end of the the top dome, if we get an aggressive move into it, we do want to be selling more aggressively for the move back low. And we can see that both in that S, T, U, and V print, we got quite a nice reversal type opportunity. So that is our, the basic element of what the double distribution will look like. However, it doesn't always play out accordingly. Now, the second type of double distribution sort of pattern you'd be able to see then is where the market actually continues with the short-term trend, as in the example illustrated. Now, in essence, what happens in this example is the market does attempt to fill out those single prints. It fails, and we see a little bit of two-way trade before the market then very quickly auctions in the opposite direction. So in this type of example, what we want to look, or where we want to look to enter, if we miss the first initiative down move, that is fine. Be careful not being too aggressive on the short towards the lower bound as we exit the lower dome, but wait for the market to give you a high risk-reward pullback into that previous dome, and then look for fresh short side opportunity for at least 8 distribution type trade. So again, a double distribution play. By the close of the day, you would have seen this double distribution, but this is the second potential pattern play you could see in the strategy 2. We've now completed the strategy 2 basic characteristics and execution style. Let's now move into the replay functionality, where we can take a look at how this trade setup will play out in the live market. Welcome to the replay series again, this time for strategy 2, which will be the double distribution strategy. Again, just a few things to point out before we actually go through the strategy. Don't forget that first and foremost, we have to develop context. Now, what I want to talk about in terms of the context, very simply, is that bear in mind we do have the 3 types of double distribution strategies you can find. So the first and foremost was when we spoke about a double distribution that occurs over a number of days. Now, this is the example we're going to talk about in this euro-dollar example, but this is the first example we spoke about as we went through the double distribution strategy. The second of the 2 that you can expect to find is where we have a double distribution that actually continues with the initiative move. So we tend to see the double distribution not being filled out, but actually a continuation, almost in a trend-like type move. And the third type that we spoke about was where we have a double distribution on low volume that actually gets filled out on the same day and ends up looking a little bit like a big distribution. So this is the 3 types of distribution you can expect to see within the double distribution. Now, the first thing to understand is that we need to just talk a little bit about the context of what was happening in the euro-dollar FX before we started with this distribution. So if we look just towards the left side, what we had was on day 1 we had effectively a big double distribution where the market had formed 2 separate little areas of acceptance. The market then on day 2 tried and tested lower, so it attempted the move lower, attempted to sort of find any kind of price discovery below day 1's price acceptance area, and it failed, and then decided to move higher and actually accept value within that lower value area, but also then just a little bit of a value area accept a little bit higher. Now, the important thing to point out was that on day 3, we actually started to see the double distribution strategy come into play, which was completely fill out between the 2 distributions and complete the strategy. Now, the 2 key points to reference when talking about the double distribution strategy is, first and foremost, we're looking to fill out the low value area. Now, the key reference points are, 1, that day 2's high, that becomes our first key reference point, and secondly, that almost that VPOC, or somewhere around the most accepted area within that second distribution. Those become our effective 2 most important areas. So somewhere around there and somewhere around there. And those are the areas I want you to watch as we go through this replay function. So let's get into it then. Let's hit the play button, and we can start to go through the strategy bit by bit. Now, as you can see, the market opens up. We're firmly inside the previous day's, value area. So a very slow, sort of docile type start to the day. Now again, the important thing to understand as the day develops is the characteristics. So all sorts of, how is the market moving? What's making the market move? Where is the market showing a little bit of volume and volatility? What are the key points within the market that's creating this volume and volatility? Who is creating the volume and volatility? Is buyers creating the move to the downside, or is it sellers creating the move to the downside? These are all sorts of the characteristics you want to be looking out for when viewing the profile replay. Now, the first thing to point out is note how for the first for the first 4 half-hour sessions, the market is firmly contained within the previous day's range. Now, what I want to point out, this is very, very key, because when a market, tends to have this much overlap, as we've seen in this area of the previous day's value area, there tends to be a high tendency of two-way trade. Now, note, the B print comes down, and quite aggressively, notice the B print. There's our first little signal. So notice how the B print, not only does it engulf the A print, but it then very quickly reverses and almost takes out the entire range. Next, we can see the C print. Note the aggression now on the C print. So we can see quite a big surge in the volume and volatility. No surprise, this is the beginning, or this is the opening of the European markets. Now, as you can see, the market's range is expanding, the volatility is expanding, and we're starting to see the market just distribute between a 105.060 and 105.30 within a 30 pip range. So again, all we're seeing is the market filling out this area within the previous day's accepted area. Now, note how the E print has come in, and finally, we've taken out the top end of the previous day's range. So the first thing to point out is note the extreme volume surge and volatility surge as we take out the previous day's high. So that would be our first referencing point, is that previous day's high. Now, the reason that's an important reference point is because, as we said, when there's a low volume area, there's a lot of stops that tend to be placed just ahead of that low volume area. So note, once that low volume area went, notice how quickly that E print went all the way from 105.60 all the way up to 105.80. So a good 20 pip move before the F print then continued. So that would be our first, in terms of execution, that would be the first sort of trade we'd be looking to execute on this double distribution play, which is a series of stop outs of anyone who's short ahead of that low volume area. Then note, our second strategy, our second play we'd be looking for is a retest of that high accepted area that we did on day 1. And that came in around the 105 or 106 area. Now note how quickly, once we targeted up there, the market double topped and then very quickly reversed and came in and tested again that area where the stops were triggered. So both our first trade opportunity, which is a play for the stops, and our second play, which is a retest of the high volume area, both trade setups showed us very good price response. It showed us a very good, on the break to the upside, we saw some nice initiation from the buyers, and then from the downside, we saw some very aggressive response come in from the sellers. And that's what's key, guys. That's what's paramount when you're viewing these things. It's all good and well having a strategy and, an idea how a market should play out and how the principles should play out. But do the buyers and sellers actually play it out in that way? And that's why this replay functionality is so excellent to add to your trading, because you can visually see how the buyers and the sellers interact with one another. Now, let's talk a little bit about some of the management aspects of this trade. Well, firstly, note, if we're getting involved for that stop break on this E print, somewhere around that 105.60 area, you should expect to see momentum. Why? Because it's a stop play. So anyone who's short in and ahead of that low volume area should be stopping out once we take out that 105.60 area. So again, it's a momentum play. In order to manage that, we're keeping quite tight risk-reward type plays. Then, once we come in and retest that sort of high volume area, again, remember we spoke about when we're trading a high volume area, we're not as aggressive on entry, but we rather want to be a little more passive on entry. So Again, in terms of the management style, well, if we're going to be aggressive with a small stop, we can afford to have a little bit of a bigger clip. If we're going to be passively entering, well, then we need to maybe manage a clip a little bit differently. We need to maybe, split the clip in two, and as the market shows us that it's turning, maybe then add on. So just two very different ways we trade within the same strategy. Now note, just to finish off, notice how the market, once it's found a high point and it's found a low point, the market then continues to do what the strategy suggests, which is when we have a double distribution, we fill out and fill in the area. So note the two-way trade, guys, and that is the key to the strategy, is that once the market has filled in the low value area, it's shown us that that initiation no longer exists, or that initiative no longer exists, we then need to see buyers and sellers interacting and distributing within that low volume area. Don't forget, the markets very often, when there is a low volume area within the market, they do tend to want to turn that low volume area into a high volume area. So that's our second strategy, the double distribution. Make sure when you go over the strategy, make sure you don't just take the example I've shown you. Make sure you go out and you find the 3 examples that we've discussed within the strategy of double distributions. More importantly, go get a host of a number of different examples over as many markets as you can find, because if you get a number of examples, you're going to learn to develop various ways in which you can execute the same strategy. So this finishes and concludes our strategy number 2. Don't forget, guys, we do this, we find these examples so that we can become better at the strategy, more comfortable, more confident. And don't forget, practice makes perfect. Good luck and see you in strategy 3. What we started talking about in part 9 was we started with the composite profiles, and we said that a composite profile is nothing more than a volume profile created over a desired time frame. Now, we spoke about some of the time frames being anything from a 60-minute to a daily, or to a weekly, a monthly, and even sometimes on a fundamental move. And we said that the reason we create these composite profiles is merely that so that we can extract various types of information out of the auction process. Don't forget, a composite profile is nothing more than a graphic depiction over a varying time of what is physically taking place between buyers and sellers. So we created these composite profiles so that we could find, the usual, types of identifiers that we would get in the volume profile. And these would include, the low volume areas, the high volume areas, the tails, single prints, etc., etc. So we started off talking about the composite profile and how, more importantly, we use them as a desired trading tool. We then moved on and spoke about volume as a key identifier. And we said that the volume is particularly important as it's a very strong measure of the degree of success of the auction process. Now, as a general rule of thumb, it's not a hard, fast rule, but ideally we want to see high volume attracting a lot of business. It's high volume tends to mean a lot of business or new business, where low volume would sort of be an identifier of maybe a lot more noise. So again, that was the key takeaway in terms of volume as a key identifier. So just make sure when talking about volume, you're interpreting, is it relatively high volume, showing potential new business and potential for momentum, or is it, sort of low volume, which is far more noise and, far more likely to see sort of mean reverting type strategies. Now, the key when we spoke about volume is that volume on its own means very little to us. So we spoke about the term of relative and relative change in volume. Now, understanding what is high and low volume is only good if you're comparing it to, say, the previous couple of minutes volume or the previous couple of days or hours. So make sure when talking about volume you're comparing it in relative terms. And Some of the identifiers we spoke about with regards to volume were the volume value area, what size was the volume value area, what range of prices, where was it located, etc., etc. We then also spoke about the volume at the various prices, and we said how if we had low volume at the extremes, whether that's the low or the high, this would indicate maybe a bad high or an anomaly, whereas if we had relatively high, other way around. If we had high volume at the extremes, that would be an anomaly, whereas if we had relatively low volume, that would be, suggestive of quite a strong, auction process off the extremes. We then also spoke about, the sudden shift and the sudden relative change in volume over the period of the day, and how this could be an indicator of, potential momentum coming into the market. We then moved on and spoke about the value area and the ways in which the previous day's value area corresponds to the current day's value area. We had 4 basic examples. The first one we spoke about was where the previous day's value area is well contained within the current day's value area. And we said this is the least directional, of the 4 types of value areas. We then said our second example was where we had a degree of overlap between the value areas. So for instance, day 2's value area would have some sort of overlap with day 1. And again, we said this is a relatively balanced day type, and again showing us a lack of real confidence for any kind of directional move. We then moved on to play 3, where we said we had no overlap in terms of the value area, and we spoke about how this sort of a play, again, showed us a little bit more directional conviction, as well as a little bit more, sort of impetus to move the market one way or the other. We then moved on to the 4th type, which was where we had a complete engulfing value area, where the day 2 session completely engulfed the day 1 value area, and we spoke about this showing us a sudden shift in volatility in the market, and obviously creating various types of opportunity. So those are the 4 examples of types of value area overlap that you can expect to see in the volume profiling. We then moved on and spoke very briefly about high volume areas and low volume areas, and how prices tend to attract and return to high volume areas, whereas low volume areas almost show us a little bit of initiative in the market, and there's a tendency for the market to want to move away from those areas until such a point that it begins to fill it out. We then finished part 9 with the beginning of our 11-part strategy development, and we spoke about 2 very specific strategies in the anomaly strategy series, and that was the low volume area, whereby we said if the market forms a low volume area, we want to remain with the short-term sort of initiative taken, continue to stay with the short-term trend until the low volume area fills out, at which point we almost want to look to play for the 2-way trade. And our second example was the double distribution, where we want to look to trade the market between the 2 high volume areas.
Welcome to part 9, Summary Checker. Just remember, the reason I have these questions here is to ensure you've understood a lot of the principles we've dealt with in part 9. So answer the following questions. What is the difference between a composite profile and a regular volume profile? And why do we use composite profiles? Then, what are the 4 areas of volume value area overlap? What is the high volume area and low volume area, and what are the basic principles that govern these 2 concepts? And then lastly, define the anomaly strategies in terms of time frame players, initiative versus responsive, time objective, volume and volatility, risk and reward. Good luck. Welcome to the end of part 9, the playbook. I hope you've enjoyed part 9 and actually starting to get a little bit excited now that we've finally begun to develop unique trading strategies. Most important, don't forget, it's all good and well me spending time helping you develop these trade strategies and showing you them and learning to interpret them, but you need to go and apply them practically. What you're going to find throughout part 9, 10, 11 and 12 is a very, very hands-on practical approach to developing your playbook. In essence, I'm going to get you to take every one of the 11 trade strategies that I've developed with you throughout Module 3, and I'm going to get you to find them in the markets and implement them into your very own playbook. So, answer the following. Find strategy 1 and 2 that we developed in part 9, the low volume area and the double distribution, and I want you to go and find them in the following markets and complete the template that I've provided for you in the playbook. So, find them in the E-mini S&P 500, the German Bund 10-year, the WTI NYMEX oil, and the Euro Dollar FX. Remember, take some time finding these strategies. Interpret each one individually. Make sure you're looking at the specific characteristics behind each one. Good luck, and we'll see you again in part 10.